Today we are celebrating the AMC day, and the partner, of course, today is Aditya Birla, Sun Life AMC. Maneesh, thank you so much for taking out time for us. Could you just first start by what's happening in the markets? What have you seen in the last few days? A sudden PE surge led by FII flows?
Yeah, that's true for pretty much entire emerging market space. That the risk is returning for fairly long time. You know, the FIs were deserting local bonds as well as whole of Asia. But over last couple of months, you know, the risk on currency has kind of come off. The Fed has, of course, hinted now yesterday evening also that you know, the number of hikes now in 2019, you know, they've brought it down to 0, and 2020 you'll have one rate hike. So it's a you know, good you know, environment for an FII to kind of participate and carry trades. So lots of money beginning to pour in across emerging market, and you know, we're witnessing somewhat same. The good news, of course, in India is that you also have you know, change in policy direction. You know, now we are looking at rate cuts, and so in this environment, not only the carry kind of you know, is reasonable for an emerging market like us, but you also have an opportunity to kind of make capital gains. So that's the reason, you know, you are having lots of flows coming in.
When we talk about flows, when we talk about risk on session, do you think central bankers are once again in focus? So you recently had some comments from ECB. Before that, you know, you just spoke about Fed as well, which is now in focus, being extremely dovish. So this last 2 months move has come because of what's happening with central bankers, and that's led to dollar index going down, which means emerging markets are in a favorable situation for flows.
Absolutely, you're right. That, you know, actually it all began with a bit of a moderation in growth across the world. You know, it began in China, spread into Europe, and now, you know, you're starting to see symptoms of growth slowing in even United States. So that's the reason central bankers pretty much across the world have actually stepped back. And as I mentioned, that Fed is now kind of looking at just one more rate hike, and you know, our own view is that, you know, most probably we're done with rate hikes, and you know, next move potentially would be rate cut from Fed. So yes, central bankers have stepped back, and that's kind of due to the fact that, you know, this since 2015, as kind of uninterrupted expansion in the world economy has beginning to see. You know, it's beginning to fade, and you know, is actually feeling a bit tired. So that's the reason you're seeing you know, central bankers, you know, turning more accommodative, and you know, we actually think that, you know, you could potentially see rate cuts coming in United States in 2020. Emerging market, actually, they weren't so bad, actually. You know, the inflation in emerging market has actually stayed fairly low, and the balance sheets are fairly clean and solid. So some bit of excessive selling that we saw in emerging market during early 2018, I think there's a bit of you know, unwind happening in that space.
Hi Maneesh, this is Nayanthara Rai joining in from the New Delhi studio. Always a pleasure chatting with you, especially on a day that is, of course, dedicated to asset management companies like yourself. So you talked about the FOMC, the two-day action, what we can expect. What about back home? You know, there are a lot of murmurs, a lot of whispers, a lot of talk about how it is that the Reserve Bank of India may surprise everyone with a surprise rate cut. Now, you of course have a committee in place, but there's a very strong belief out there that India does need to have a far more loose monetary policy. We need more liquidity to come into the system. How do fund managers, asset management companies like yourselves navigate through all of that? And at a time like that, are you also maybe looking at changing and rejigging the portfolio for such an action?
Absolutely, Nayanthara. You know, one, that it's not going to be a surprise in April if RBI delivers a rate cut, because that's pretty much baked in by markets. What's been surprising, of course, is the kind of policy volatility that we've seen, and not many people are kind of talking about it. That just about a few quarters ago, RBI was actually talking up the rates, was excessively hawkish, and there was a bit of a hubris in terms of actually hinting to markets that markets were wrong in actually not pricing inflation well. A complete U-turn that we've seen now, where RBI is likely to be very, very dovish. And actually, it's a right move. Finally, we have a sane, central banking or policy setting which is underway. India does need lower interest rates and lower real rates. If you kind of look at the historical context, we really have seen such elevated real rates in India for not only government of India, which is actually borrowing at a fairly high real rate over inflation, but also for the corporate. The credit spreads have widened dramatically, and in an environment where the profit growth has not been forthcoming, and economies growth at best has been kind of lackluster, the real rates in India for all sorts of economic agents have been fairly elevated. So it's a good news that that now RBI is beginning to hint at looser policy and looser financial conditions. That should kind of aid not only the economic growth per se, but...
So Maneesh, I get your point. I get your point. You're all anticipating it. I take your point. You're all anticipating it. I take your point that you're all anticipating it, Maneesh, but something else I want to talk to you about, and sorry for interrupting you there because we are running out of time. You're getting a scary call today from Fitch, for example. Of course, it's downgraded the entire global growth, but it's also done so for India. In the last couple of months, especially since Freaky Friday in September with what happened with Divan Housing and India Bulls, there has been, we've seen credit offtake, for example, being hurt. That's prevalent in Motown. Auto sales are coming down. In February, look what's happened with air traffic growth. How are you reading these signs? Is it time to turn bearish? Is it time to get worried? How is this an aberration? How should one navigate through this? Because there seems to be some signs that are coming in, which is bad news for the economy.
Absolutely. The macro in India, the general economic growth is turning tepid. Consumer, for sure, which is an important part of Indian economy, is actually, that part of the business is looking to is looking a bit tired now. So, we've had a phenomenal growth in the consumer space over the last couple of years, but the pay commissions effects are fading. And in general, we're seeing because of the NBFC crisis, the access to finance for a lot of consumer actually may kind of start to come off. So I think, cyclically we're looking at lowish consumer growth. But the good news in India, of course, is that after a fairly long period of stagnation in the investment space, particularly in the household, there are signs that construction activity could begin to pick up. A few sectors may begin to kind of see investment growth. So it's not very clear. It's somewhat patchy, as far as India is concerned. But I kind of agree with you that we kind of looking at fairly challenging times ahead as far as growth is concerned in India.
How would you play, whatever growth you're looking at? We are looking at challenging growth, which means we are looking at slightly lower rates of growth, not any issue as far as growth rates are concerned. So how would you play? Would financials be one of the best play? Would consumptions be one of the best play? Export sector is not picking up. How would you look at it?
So I guess, for India to kind of rebuild growth now is going to kind of depend on the investment side of economy, and investment in both household as well as industrial. So both set of investments have actually been tepid. So my sense is that most government policies and RBI policy would be out there to aid the construction. Investment in dwelling should improve in India, and I think now our policymakers understand that. So I think that complex would actually begin to see some traction if policies begin to assist them. I think few businesses like steel, petrol refinery, and so on and so forth would kind of see some traction in investment. So basically, to kind of play just from a pure growth standpoint, I think that part of the business would actually see some traction. And consumer, on the other hand, would actually, it's very, very unlikely scenario that you would see 7-8% growth in the consumption in the economy. So I think that part of the business or that part of the economy would actually begin to slow down.
Right, Maneesh, thanks so much for taking out time for us. Always good to talk to you. You rarely see Maneesh talking to any business television channel, but today, of course, he has chosen ET Now to speak.